right, excellent. Well, welcome to this webcast hosted by the American College Maguire Center for Ethics in Financial Services. I'm Azish Filabi, the Executive Director of the Center for Ethics. I'm also an Associate Professor of Business Ethics here at the college. So we called our panel today Beyond Fiduciary Duty because the mission of the Center for Ethics is to offer research and programs that go beyond the rules of market conduct to help individuals and to help companies think more critically about solutions for the benefit of society. And so with that in mind, I can't think of a better topic to discuss at this time than the role of technology and AI and how that will impact society. So just to get us started, the SEC cites that there's been an acceleration of the adoption and use of predictive data analytics by both broker-dealers and investment advisors. They cite news reports that indicate that companies are either experimenting with or using AI for areas such as portfolio optimization, risk management, fraud detection, tax analysis, and even relationship management. Reports also indicate that we're not yet at the phase where AI is actually integrated into client-facing technology and generative AI is not being used consistently. In other words, there's a lot of interest in it, but it's still a lot of work that needs to be done for it to be integrated into the industry. And specific stats are hard to come by, but we know for certain there's a lot of interest in this topic, and there's a lot of potential for helping client interactions as well. So before I introduce our esteemed panel, there's some housekeeping I'd like to do for purposes of the webcast. So I'll now introduce our panelists, and I'll tell you a little bit about their background. Kristen is currently the founder and CEO of Pattern. She started her career at the US Treasury Department, and she worked on consumer financial protection policy, and then has transitioned into wealth management. And prior to creating Pattern, she worked in both the US government and Treasury as well as state government in Oregon. She's also worked in various financial services companies, including fintech companies such as Square, Acorns, and Vault Investing, as well as Cable Hill Partners. We have with us as well David Blanchett, Managing Director and Head of Retirement Research at PGIM DC Solutions, where he not only develops research, but also innovative solutions to help improve retirement outcomes for investors. And prior to joining PGIM, David was Head of Retirement Research for Morningstar Investment Management. He's also currently an adjunct professor of wealth management with us here at the American College of Financial Services. And our third panelist is Vince Martinez. He is General Counsel of the North American Securities Administrators Association, NASAA. And Vince has a strong background in investment protection and regulatory coordination, and he's worked previously at both the SEC and the CFTC. Prior to joining NASA, he was a partner at the law firm of K&L Gates in their white-collar and regulatory defense practice. So you see, we have a broad range of experiences here, and I'm very excited to talk to them about a variety of trends and use cases for AI, as well as a deep dive into governance and policy considerations. And as many of you are likely aware, there is a pending SEC proposed rule on the predictive data analytics that addresses both broker-dealers and investment advisors. And they're addressing risks to investors from conflicts of interest that are associated with the technologies that are covered by that rule. And what technologies are covered by the rule is indeed a broad issue that we'll be touching on today. The rule was proposed in August, and the comment period has recently ended in late October. So we're now in the phase where the SEC is reviewing those comments, and we'll hear more from them, hopefully, in the coming months. So with all of that in mind, I'd like to now turn to Christian, and we'll get started with the conversation.
Hi, how are you?
Excellent. Nice to see you, Christian. Thank you so much for joining us today.
Of course.
So you recently launched a new technology platform called Pattern, and we'd love to hear more about the platform and what needs it's aiming to serve within the financial advisory space.
Yes. As you so kindly stated, I started out working on financial innovations at Treasury, landed in wealth management, then quite naturally moved into financial technology or fintech. And most recently, I helped build and launch Cash App Investing, which I believe is one of the fastest growing investing firms in the US. Around the time of COVID, I noticed that there was really this first generation, at least in kind of my purview, of wealth tech. We have, these really great robo-advisors, but that there was so much more we could do with technology. As we started talking to customers or potential customers, we saw that folks, A, wanted a human in the loop, but B, wanted this digital first experience. So long story short, started building Pattern, a broker dealer, an RIA, all that good stuff to really serve our clients. And Pattern is a digital wealth management platform that matches each client with a certified financial planner, a financial coordinator, and provides access to powerful personal finance software. So once a client is in the app and they're matched with their advisory team, they can message their financial advisory team on demand, use self-serve investment management tools and saving tools, and schedule comprehensive financial planning calls with their advisory team again, all via the app. So really high level, especially for this group, I'll give you kind of the dirty. We are aiming to serve through technology, key vendors, and people about 19 times what a traditional financial advisor would serve in terms of their book of business. And doing so in a way where the customer experience is kind of our North Star. We use AI and have plans to further leverage AI, which I can talk a little bit about from a practitioner's standpoint, if that's of interest.
Yes, we'd love to hear that from the advisory perspective. In particular, many of our students are financial advisors, and they'd love to hear about that space that you're serving.
Okay, I'll give you all a high level, but really step by step how practically we're using AI, kind of given the regulatory guidance. And we don't have our counsel on this call, but there's no advice here, just kind of sharing stories. But we still think that having a human in the loop is critical, but that our people and the financial planning process will be augmented more and more over time by AI and other technologies. So given our perspective, we are mobile first. We really push kind of this on-demand feature because that's what the data has told us, that our target market really wants this on-demand experience and mobile first experience, even though, again, they want that human in the loop. Given that, about 70% of our client communications come in via chat. And based on these chat conversations, we are continuing to build out a rich corpus of anonymized conversational data between our advisory teams and our clients. To save our financial advisors as much time as possible, we have built an internal tool that basically sits on top of ChatGPT, while our less experienced financial coordinators can then use this internal tool to enter client questions that they receive from in-app and receive a strong draft response from our internal tool. Behind the scenes, this tool that we built internally basically submits relevant data from our corpus as additional context to ChatGPT. So really, we're thinking, okay, how can we save the financial advisor as much time as possible, really scale them? So we use our financial coordinator. Hey, we're putting you on this financial advisory track. So you're going to be this first line of defense. And we're basically giving you this kind of mentor based off of our data to give you as much information as possible to help our clients first. So once they get this response from our internal tool, they might loop in another expert on our team. Maybe it's a tax question, what have you, the proper licensed folk, or might have them jump into the conversation directly. And we have several planned enhancements, but this gives you kind of a flavor of how we use this today. In a future state, we would like this chatbot to interface directly, of course, with clients and answer any questions that do not require a licensed person to kind of jump in. We would also like to introduce a classifier that basically classifies any comment question that comes in. Can a chatbot answer this question, or does this need to go to a licensed professional? And that's kind of where we sit today, given our kind of financial advisory supercharged by AI and technology over time standpoint.
Really interesting. And just for clarity in terms of your platform and how the advisors interact with it, are they on staff with you? Is this for a broader advisor population? If you could talk a bit about of that onboarding process for the advisor community.
Yes. So there are a few early companies in this space. And something that we saw before we wrote a line of code and really kind of dug into the data, did customer interviews, old kind of employee interviews, is that we wanted these advisors to actually be pattern advisors so that A, we could own our data, we could manage these assets on our platform and really have control of quality at the end of the day. So I get questions all the time, can we buy you from traditional financial advisory firms so that we can supercharge maybe even segments of our clients and move them onto this platform. But for now, only available for pattern advisors.
Okay, fantastic. So I'll come back and have more questions. We're going to be transitioning to governance a bit later in the conversation. And for now, I want to bring David into this discussion around trends and use cases. David, I'm curious about the technology trends you've been seeing and what you're most excited about, particularly if there's anything around generative AI.
Sure. So, it's hard to say what's going to happen. An example I like to use is that, something like 90% of Forex trading today is using algorithms and, 3/4 plus of the stock market. And maybe that's not shocking, but, if you would have told a bunch of asset managers 20 years ago or 30 years ago, there's going to be computers trading, these massive portfolios, like they wouldn't believe you. And so I think that, so far we've seen, I think, early days on where and how AI can, have a positive impact on the environment. Mostly, I would say like in the data space, things like analyzing data automation, things like bank fraud. One kind of fun example that I wasn't involved with that actually happened at Prudential was a tool to help individuals figure out where they should retire. So you can ask them a series of questions and it can kind of give them guidance on where they should end up based upon, a host of preferences. Do you like warm weather? Where do your kids live? Where it would be really difficult to build a model to tell someone what the result is. And you mentioned generative AI. I'm sure everyone here knows what that means, but it's always good to kind of define terms right. What I define it as is a system that learns, right? It can create something new from previous stories, patterns, outcomes. So it can help people, figure things out they couldn't otherwise. I think that one of the more clever tools that are created, or the names is Copilot, right? That Microsoft is related. To me, I think a better terminology for kind of where it's going is this idea of a first officer. I have a friend who's a pilot, so I know the distinction between a captain and a first officer. But I think that with all this, what I still have concerns about, and we'll get to this I know more later, is just the role that these tools can play in the absence of having kind of that person that gives that final guidance. When Christian was talking about the way that they employ AI, like that's a really good model, right? One that is kind of helping advisors answer questions more quickly than having to do the research themselves. Like I have no problem if someone wants to know, like, how much can I save in my 401k? Well, like it's kind of a waste of time for a human to have to look that up, right? Mm-hmm. A robot just can answer that question. And I think where this can be really viable is this advice gap. We have a massive amount of people in this country, especially younger Americans, those are lower incomes, that do not get financial help. So I really like target date funds because they've really helped simplify investing for people. Advisors don't like them, but like, come on, like the people that use target date funds are folks that have like $1,000 balances that won't get help. Well, like they could use this, and so when we can create solutions where individuals that otherwise couldn't get a personalized strategy, to me, that is kind of the longer term end game for all of this, where we're going to help people accomplish better outcomes where they really can't afford what you would get from a quality financial plan.
Absolutely. And I think what I hear in both of your responses is that the algorithms, what we might call traditional AI, had been integrated, particularly in the internal use cases, for a number of years now. And certainly with Gen AI being in the past year, the predominant area of conversation, we're still in the learning phase within the industry. People are experimenting with it. Not as much client use yet, but perhaps there's some experimentation going on within companies to figure out how to bring it to that next level.
Right. I mean, so like the Prudential, the tool, like we, it's hard to figure things out. Like, it isn't by itself a business, but it's a novel thing to have to help clients, potential clients, whomever, have an AI experience. I think that'll be very much the norm in a few years, but it's relatively, I think, new for the way that individuals would interact today.
Absolutely. And moving quite quickly. It's only been a year, but
Right.
we are seeing a lot of excitement and interest around it. Christian, I'm just going to circle back to you on one point, because I think David mentioned an interesting concept with respect to demographics. Is there a certain demographic shift that you're seeing that motivated Pattern and its approach to customers?
Yes. So we surveyed or interviewed over 1,000 people, again, before we ever wrote a line of code. And what we saw was that basically 25 to 54-year-olds making $100,000 or more, 85% of them wanted a digital first solution, but holistic financial planning. So that's literally what we're building, that person, but doing as much as we can with technology to then pass those cost savings, but also create a customer experience that that target market really wants.
Absolutely. Thank you for that clarification. Vince, I know you've been following the policy conversation really closely and provided a number of public comments, particularly in the SEC process. But before we get into those details, I'd love to hear your perspectives on where you're seeing the opportunities for increased use of technology in the advisory relationship.
Okay. First of all, since I'm a former regulator, let me begin by disclaiming any statements I make solely my own, not necessarily those of NASA or any of NASA's members. So, Christian and both Christian and David had talked about the use of advisory technologies in the intake portion of a relationship in order to help build customer profiles. I can certainly see benefits there, depending certainly on the nuance and specificity of the engine. Sometimes, again, getting to Christian's point about wanting a human in the loop, some questions investors have are not things that are susceptible to structured information fields, or they just don't even know how to ask the question themselves. So there's certainly value that has it there. But in terms of the potential benefits of these relationships, I see benefits on the customer side and benefits on the registrant side. So, a lot of folks are wary about engaging in financial planning just to begin with. And so there's a barrier that's not just an information barrier, but just sort of an effort barrier. And so to the extent that digital tools can help make it sort of more comforting and easy or efficient to sort of reduce that barrier, there's real benefit there. In terms of what could happen on the registrant side, it was funny that Christian mentioned having ChatGPT with some bespoke answers for agents, and that's an interesting idea. We use ChatGPT here for some of our content, but our standing rule is don't take anything that it says for gospel. Check everything, right? And I'm sure the same for any rep that would be using it. But I think another thing that AI could do in this space that would be very helpful is to help representatives identify patterns of social engineering or exploitative withdrawal requests. In other words, if it flashed to the rep, this customer has never made a request of this kind or in this form before, that could be immensely helpful, for the possibility of limiting instances of exploitation. I think that when you start to get into interactivity, that starts becoming the place where the policy debate on what the bookends on that should be and what the standards of conduct around them could be. Because certainly if it's simply asking questions for the purpose of absorbing information, that's one thing. If it's asking for it for a business related goal that the firm is trying to reach, that becomes another. And I also think that one of the potential benefits is enhanced portfolio monitoring. In other words, it can keep tabs on a portfolio to a degree that a human advisor can't. However, what it then does with that information, whether it becomes a vehicle for encouragement for trading, encouragement for getting into different strategies, that's again where it starts to be problematic. And I think that the thing that we had said in one of our comment letters is all these things are tools. They could be used for good and bad. And it really is a question of the motivations of the folks that are using them.
Absolutely. And that raises a number of good governance and policy considerations for us to discuss. And for clarity, I think one of the things that you had mentioned was the issue of accuracy with the Chat GPT and generative AI functions. And I'm sure many in the audience have been reading the news reports in terms of this idea of hallucination. I don't personally love that term, but basically it makes mistakes. And there is a lot of work to be done for the technology to be fully accurate. And that has raised a number of policy considerations. Sometimes accuracy is not important. Maybe you're writing a novel and you want creative ideas, and this is a tool that can help you generate new ideas. But in an industry where accuracy is really important, then governance becomes really important as part of that process as well. But I think we can transition now perhaps to some of these governance considerations. And Christian, I think we'll go back and start with you and how you're thinking about governance practices, particularly in the fiduciary space, and how you and your colleagues at Pattern are considering the various safeguards that you can put into place.
Yes, so Pattern is an RIA. Obviously, all advice is rendered through our RIA to our clients. In terms of kind of, again, as a practitioner, how we are leveraging kind of our internal governance and kind of thinking about new technologies. So of course, we implement QA, quality assurance, standard code reviews, and follow best practices when it comes to implementing code changes and new features. From a regulatory and operational standpoint, we're at a stage where there is always a human in the loop, as I mentioned earlier. And again, so our own data sits on top of ChatGPT. And then once, this financial coordinator comes in, submits a question, it uses our context from our data to then, spit out a response. So there's always a human reviewing and ultimately sending any AI generated response to a customer. And for a few reasons, we review almost all customer chat communications at this time. And this allows us to basically be able to leverage the best responses from our financial advisory teams while ditching the less than stellar advice as part of our corpus. So really, it's making us better, I would say, all around. And really, I would say, additionally, these reviews have helped us improve as a team, unearthing what training staff and team members need more so than any technological issues.
Absolutely. So a related question is around trust. So invested in these approaches, having the human be at the forefront of the interaction. And we all know trust is really important to the advisory relationship. And I'm curious, as you think about the role of technology and whether it can help improve trust in that advisory relationship with the clients, if you have any reflections on that.
Yeah, so I think time will tell, but in a couple of ways, it can most certainly improve the customer experience, right? I hate to say democratizing because every fintech says that, but really democratize access to more equitable information. Also faster response times, but also I think it was Vince's point, really helping in the area of fraud prevention and detection. That's huge, right? Any fintech that launches sees maybe 20% of their first clients fraudulent. So I think that those are two obvious areas where certainly AI and technology can help in general, can help build trust.
Absolutely. And I think too, in the business model that you're describing with Pattern, the supercharged research and enabling the advisor to provide timely advice, competent advice, and connecting with the client's needs in a more just-in-time approach. From some of the trust research that we've done at the center, we see that simplicity is actually a big factor in the trust relationship. Of course, it must be accurate, but that's a bit of an assumption going into the relationship. But that simplicity in the interface could be a factor. And as you say, time will tell as we see how these things turn out.
Side note, I love that you said that. So when we first started looking at some of the responses that our tool gave us compared to maybe some, responses that a financial advisor gave that we didn't love, what we saw is that simplicity was a big piece of what our tool could kind of, spit out versus, Yeah,
and as anyone who's taught a complex subject, it's really hard to get to the simple answer to questions and to be able to put things in context for students. And Dave, this is something that you know a lot about and the work that you do and the teaching that you do as well. So would love to hear from your perspective in terms of the biggest governance challenges that you're concerned about when thinking of embedding AI into the financial relationship?
It's funny, to go back to trust, I actually have concerns about consumer long-term trust in these, given misinformation, deep fakes, things like that. I think that now it's new and novel, but I mean, I've done surveys asking people about, interest in AI, and young people love it. Old people are like terrified. And I think that it'll only get worse in time as we have these bad experiences and bad things happen. So I think that the perceptions around how it's going to be leveraged externally is going to change over time. But I mean, thinking about like my experience when it comes to, embedding this in solutions, I would say that, one thing I've done in the last 15-ish years is been actively involved in building or maintaining a variety of advice engines. So tools that can provide, robo-type solutions that can provide at scale to millions of people advice and guidance. And you mentioned I can never say it right, hallucinations. Yeah. Like that terrifies me. Okay, because I have been a part of things where we've had to write some really big checks. Okay, because when you have these automated-ish tools, if anything goes wrong and the person makes money, they get to keep it. If they lose money, you have to pay them. And so, any kind of tool and process where I can ask it the same question and get different answers, like really, really worries me. Right now, I know that there's like ways around that. There's ways to do things, but it's the nature of like the cost of the wrong answer. Like if I asked some kind of chat GPT, like how much can I save in my 401k, and it tells me I can save $24,000 or 28, it's the wrong answer. Okay, well, like I'll be limited in my 401k, it's no big deal. Like where I worry more is when there are these recommendations that may not be deemed prudent ex post. Someone could say, well, like the algorithm that it was using was based upon bad information. So like I get very nervous about more of these kind of like agent-based models that can go in and kind of figure things out, and maybe it would evolve the advice over time as you give more information to the end user. So I maybe I'm biased and I'm old school, but I tend to like more of these rules-based approaches where I can very easily track how did I get to that answer. So like this is the exact way that the person's risk tolerance or their portfolio, whatever else happened. Because if you don't have that, you have like a reason for someone to sue you, because like that's what happens, right? Like if things go wrong, they're going to sue you, and if things go right and you messed up, well, that's fine. But like regardless, there's this massive liability here. So I think this is very powerful. I guess just given my experience, using even some of the more basic tools, like the idea of a non-persistent, consistent way to get to advice and guidance worries me when we start talking about managing portfolios. Now, just to be clear, like no advisor does the same thing the same way. So we can't acknowledge that there is like one way to do things, but at the same time, a tool that's created that doesn't consistently give the same advice and guidance for the same person, I have concerns.
It's a great point, because I hear sometimes that there's a similarity to some of the other tools, calculators, for example, that at one point had changed the nature of doing financial transactions, accounting, a big game changer in education, in the math space, for example. But a calculator gives you the same answer every time, unless you push in the wrong numbers. So if you have a human error, that's a different story. And that lack of consistency with the AI tools and generative AI in particular does raise a new question, which I think you're raising, Dave, is around accountability and liability. So if in the instance where there is a mistake, then between the corporate entity, the advisor, the technology provider, it creates a whole new category of legal risk, because the AI tools, the more complicated ones, are not explainable. Is that the crux of it?
It is, and like these are just going to be calculators to people. They're not going to like no one is going to want to understand all the secret sauce behind it. So like the fact that you're not getting like the same result or consistent results, like that's not on the user, it's on the technology provider. I mean, like that being said, there should be ways around this. I mean, I think about all this regression testing we do. We test, whenever we make a change, we test tens of thousands of cases. I mean, there are ways that I think you can do audits. There's some level of assurance that it's doing a good job. But to me, it's just the nature of not having, a very well-defined process to lead to advice in those situations where it is pure robo, for example. that I do get a little bit nervous.
That's fair. And I think where we see difference in human advice, right? Different advisors will give different advice, and that's positive. We want to have a diversity of viewpoints within the market. Yet in this case, that difference in advice is not well documented at times, right? So you don't really necessarily, the technology doesn't necessarily tell you why the answer is different in one case versus another. So it raises a whole host of new approaches that auditing might capture in some instances, but in others, we need perhaps new technology challenges, or we need other guardrails that are put in place in terms of how the technology works in the first instance.
And maybe it becomes reliable. Maybe we could end up asking it, like, Mr. Robot, we'll call it Hal. Hal, why did you give this person, this, and if it can honestly tell you the answer, that's very useful, right? But what if it doesn't or it can't? That's when all of a sudden I think it becomes very difficult.
Right. No, absolutely. Okay, so we'll continue to discuss some of these policy challenges. And Vince, I know you've been thinking pretty deeply around the use of AI and predictive data and analytics within this space. So just to set up the question for you a little bit, I know NASA had submitted a couple of comment letters this year on SEC's proposed rules. Earlier in the year, there was the rule relating to digital engagement practices. So these are the nudges, the behavioral science approaches that some platforms will use to, for example, encourage people to trade. And so I wonder if maybe we could start there. What are the practices that you've been observing in the market, and where do you see the biggest investor protection concerns?
I'll probably come back to this theme a couple of times. I think the biggest set of potential investor protection concerns that we see in this arena is in self-directed brokerage. And it's for two reasons. One reason, from a regulatory perspective, firms that are offering self-directed brokerage will take the legal position that what they're doing is not offering a recommendation, and therefore no standard of conduct applies to that advice. And the Trade Association for Broker-Dealers, SIFMA, has taken a similar position. So that's problematic, just to begin with. The idea that an investor could have a technological interaction with a firm to which that firm feels that it has no obligations for the consequences that happen on that platform. So that's one thing that concerns me. But it's also the nature of the way that investors are attracted to those kinds of platforms. I think things are a little bit different, this year as opposed to maybe 18 months or 2 years ago, when we were in a much looser, freer money environment and people were at home, by virtue of the pandemic. And in that case, the sort of gamification features that were, common for some of these platforms seemed attractive and fun. And from my perspective, and I think others at NASA would share my view here, is that that's not really the attitude that we would hope prudent investors would take with respect to their money. And some of these gamification features, cater to this urge to sort of interact and play with it almost like it's like a home blackjack kind of thing, and you're just sort of looking at the numbers and getting excited. And a more prudent take for most investors, certainly most retail investors, is find a strategy that works for you for the long term and just sort of set it and forget it. But I've never heard of like a nudge from a Robinhood, for instance, that said, like, look up the only index fund you'll ever need, right? Like, you never hear that one. So that concerns me. But also, the social media aspect to gamification has like one feature that is really troubling to me. In any other social media platform that you'll encounter, there's this tendency to suggest to you what it already sees that you have some sort of preference or penchant for learning more about. And if an investor comes in because that person has been compelled to make their first visit because they're interested in crypto, or they're interested in options, or they're interested in, God forbid, like leveraged and inverse ETFs, whatever, to then have the machine say, just as ChatGTP, no matter what the question is, it's excited to hear the question. And it'll say, let me help you with your inquiries about leveraged and inverse ETFs, right? And it sort of like validates that thing that goes in, because that's how social media works. And so that's the kind of thing that really concerns me, is this sort of like pervasive set of influences to get people to spend more time and to get excited about it. Not that people shouldn't be excited about investing, but they should be cautious in the first instance.
So I'm going to play devil's advocate here. And, you know, we have phones that send us notices regularly. You can control the notifications on your phone. Why should a banner on your phone be considered a recommendation?
And Azish, you know, when we had this call, because, you know, the thing that the SEC had put out on digital engagement practices, it wasn't a rulemaking, it was just a request for information. You know, let us know what you think. And our position was that many of these things functionally are recommendations because they're designed to act. When it comes to self-directed brokerage and for firms that are using payment for order flow models, they don't care what you trade, they just care that you trade. And so in that instance, on the one hand, the firm can say, it's not a recommendation, I didn't tell them to buy Apple or whatever. In our instance, you know, we say, look, it is a call to action. It's trying to get you to, for instance, you'll get a notification, what are the top 10 hottest stocks that are being traded on this platform right now? You know, what are people that are similar to you into? What is this influencer, you know, into? And if you were getting these calls from a human, you would understand that the reason that person is bothering to pick up the phone and bother you is because they want you to do something. And so, you know, the sophistry that some of these messages, because they're given in an automated format that can reach thousands of people at the same time, are somehow different from recommendations, is something that is sort of antithetical to our way of seeing things.
And also, I think what I'm hearing is that the recommendation to act might also not be always in the best interest of the client who maybe needs to buy and hold and not necessarily be thinking about trading on a regular basis. So that action in of itself could be considered a recommendation.
Yeah, and I think that's one of the, you know, concerns. Gary Gensler, the chair of the SEC, is the champion of this whole notion of predictive data analytics being the basis for the rulemaking, and he comes at it from the, you know, from the perspective of, you know, if an algorithm, if a machine is looking at your preferences and is catering to those preferences, it's doing so in an effort to keep you engaged. And for most of us in prudent investment relationships, like in an advisory relationship, usually you're having an initial conversation, you're figuring out what your risk tolerance is, you're telling them how much money you have and where it is right now, and, you know, your plans for retirement, getting kids through school and stuff. All those factors get blended in and a recommendation comes out. And then perhaps there's the reason to periodically adjust that. Either the performance is different or your life experience is different. But, you know, these predictive data analytics tools are finding all sorts of other reasons to interact with you that are more in the firm's interest than yours, because for most people, once they have a solid plan, absent, you know, calamitous life change or, you know, a particular investment choice that just fell through the floor, there's not really a reason for this sort of constant interactive engagement that you're having with your, you know, with your investments, as you would if you have one of these self-directed platforms just sort of constantly buzzing you all the time to get you to think about it.
Absolutely. So let's transition a bit to the predictive data analytics space and the SEC's rule or proposed rule relating to that. There was an overwhelming number of comments on the rule, most from industry and industry associations, quite critical of the rule. And one of those criticisms that I wanted to ask you about, well, a couple of them actually. So one is that Reg BI already requires that broker-dealers act in the client's best interest, and the investment advisors are already governed by the fiduciary standards. So that was one set of criticisms. Why do we even need a rule that is specific to predictive data analytics? Where do you see the gaps and where this rule might be filling those gaps?
So a couple things. I think that when you're talking about advisory relationships, that really is in a different camp from brokerage relationships, because even a robo advisor that is purportedly all machine based will still recognize that it's supposed to operate in a fiduciary function. And my understanding, and I'm getting over my skis pretty quickly here, but my understanding is that in most sort of like plain vanilla algorithmic offerings, what it's doing is it's offering you what could be considered a safe, diversified, standardized portfolio. And that is something that the firm, if it ever was to face a regulatory inquiry, would say, we were prudent, we exercised care, and we were loyal to our client in doing so. I think that when you're talking about brokerage, and particularly self-directed brokerage, these sorts of things don't apply. Where you're talking about because Reg BI comes in when we're talking about retail investor interactions, when there is some sort of recommendation being made by that broker, the point of sale disclosures, the duty to identify and potentially mitigate conflicts. All of these happen at the point at which a broker is supposed to be interacting with that customer to say, buy X as opposed to Y. And so again, that there's that gap for self-directed brokerage. But the other thing that I would say more generally, and I recognize that the rulemaking is a big deal and it would cost a lot of effort and money. However, two things. One, we did 3 examination sweeps of firms, both to look at their state of behavior before and after Reg BI. And one of the things that we found was for certain things, there was sort of a slow and grudging acceptance to take on certain of these new regulatory burdens and the 4 duties that one has under Reg BI on the brokerage side have been spottily picked up. And some of the things that were of particular concern to us, particular kinds of like high cost, high risk, illiquid investments, we weren't seeing the kind of abatement of those sort of practices that one would see if you're looking at an enhanced regulatory standard, all of which goes to say that like even regulation, when it's comprehensive, may not get you the result you want quickly. But the other thing is, in this arena, I do think that one of the values of the SEC's proposal is it comes up with, it identifies the problem and it comes up with an approach for firms to actually go through to do that. Now, if that were to be done by something different as opposed to a rule, what we do is, we sort of send out some FAQs, and then there are some exams, and then maybe there's an exam report, a risk alert. Then finally, some enforcement actions begin to occur. That can take years. It can be spotty. And I do think that there is a paradigm of analysis that is new here that firms should be expected to go through when they're adopting certain of these technologies.
Absolutely. And, I was at an AI conference earlier this week, and one of the things that I heard that I thought was really encouraging in terms of the frameworks for regulation around AI is it was an engineer comparing it to a car. The best way to have a car go faster is to put on brakes. Because when you have brakes, you know that you can go fast and you're still going to be safe, right? And so that allows you to introduce speed into the process. And I think what you're describing in terms of having some regulatory certainty around what these procedures are, what the expectations are, then allows people to be able to build safe AI and to have clients interactions where they know there's an agreed upon procedure and process so that people are going to end up in the right place.
Yeah, I absolutely agree with that. And I think, and I understand many of the industry criticisms. Azish, when we talked about the expansiveness of the definition or the expansiveness of the definition of investment interaction. Well, that's what the commentary process is for, to help educate the SEC as to there are places where some nuance could be introduced into that rule. However, I would be much more distrustful of something that said the basic idea that you would be expected to analyze these products and understand how they work before you introduce them to customers. Like, I don't think that would be a valid criticism, even though, the SEC points out that some of these technologies, when presented to the firm that is using them, sort of come as a black box. That still doesn't excuse the firm from understanding them, whether it's interaction with the vendor, bringing on an expert to understand them. You don't just get to, sort of use a tool and get it out there. But I also think that the pressure to do so is intense, because firms are using these tools. Firms are making money using these tools. Firms are getting investors excited to come to them, like Pattern, because they're using these tools. And so everybody feels that they have to have some rules in place to say, well, before you do, maybe figure out how it works, not just generally, but how it works in your business model. That's prudent.
Yeah, absolutely. Excellent. So I think there's more to discuss in the regulatory conversation. And if we have time, I'll circle back to a couple of follow-up questions. We do have quite a number of questions in the Q&A. So thank you all in the audience for submitting those questions. And I'm going to try to summarize a couple of them. And maybe Christian and David, these are perhaps directed for you in terms of how the AI technology works effectively or maybe not effectively. One is whether the AI bot can read faces, emotions, and eyes. Many people say one thing with their words, but their body says something else. So just that readability aspect of the AI and how that might affect the second question that's here in terms of client adoption. Right. So are clients going to be willing to input their personal information into something that is this broader AI system? Are there any issues with respect to the vulnerability of financial information and how close that is to people's livelihoods, and this expectation that AI and technology will create solutions? So if either of you might have thoughts on those questions.
David, you first.
Yeah, I mean, the first part, not yet. I mean, they can't. I mean, maybe they can't do it yet, but they're going to be able to do so. I think it's highly naive to suggest that maybe just because today they can't read emotions and it can't somehow figure out what you're thinking or doing better than a human is incredibly naive. So maybe today humans win. Longer term, I'm just not so sure there. With respect to the data stuff, I mean, I think data usage is really important, so I do a lot in the employer space, and participants are very weary of giving data to any kind of tools that they think the employer is going to find out what they're sharing with any kind of like third-party tool. So I think that as long as you're upfront and they're aware of it, I mean, to me, again, I think that the golden standard is and should be a incredibly well-qualified financial advisor for all Americans. That's just not possible. There aren't enough advisors out there. So I think where you see, especially like these robo hybrid HALs, or whatever you want to call them, existing in the future as a lower cost option for someone to get potentially very good advice. I think better advice than they have historically. So I definitely see a path forward here because I think that the technology will improve dramatically in the future. What do you think, Christian?
Yeah, I would agree. I will say that ChatGPT 4 can ingest images, so we're getting close. We're getting close. And then in terms of data, et cetera, I mentioned earlier that our target market, we spend so much time with our customers because, creating a really delightful customer experience and amazing financial planning and making this very accessible is really our North Star. So I would say, at least within our target market, 25 to 54-year-olds, typically high earners, we do see that folks are, they've been primed with robo-advisors. So they know that, okay, this is normal to enter this information. And actually, we have gotten some results in testing where if we, don't ask enough questions, or like, I don't know, can you really give me a portfolio recommendation off of, only that set of questions? So we see that actually people are very primed, especially again in our target market. Maybe there are certainly folks that are not in this target that are very willing to give us information and know that the more information that they give us, the better results really that they will get in terms of suitability, advice, what have you. And yeah, I think that's what I would say. I think somebody mentioned cybersecurity. I will say that we, do all the things in terms of cybersecurity. We have huge partners that require, huge cybersecurity due diligence exams, and know that, especially where I sit, cybersecurity is one of the only things that keeps me, well, not only things, but one of the biggest things that keeps me up at night, and is always at the forefront in terms of data security, because going back to trust, you have one data link, you're basically out. So yes, cybersecurity is of the utmost importance and will be going forward.
The bread and butter of the data space. Vince, did you want to get in on the response for this as well?
Yeah, the only thing that I wanted to add, and it's already happened that they've noticed that there can be differences in the appreciation of human reactions when you're talking about white faces versus faces of color, right? And that's, you know, that's a function of some of the cultural biases that are already built in large language models. I mean, ChatGPT just goes out there and runs around in the internet, and it carries all of our collective cultural biases, right? And so I think unless and until we get to a place where we're confident that data is pristine and has those biases eliminated, that would be something that really has to be taken into consideration if you were to get into sentiment analysis or something like that.
Right, absolutely. And another plug for more advanced technology, more improved technology, more testing before it's used in practice. We have another question here that goes to, I think, advisor education and experience and training. And I wonder if any of you have thoughts around this question. Says that this individual coaches advisors, and they're sometimes using risk tolerance tools that have AI embedded in them. And does the panel feel that platforms are vulnerable to advisors' lack of experience and training? Is there an observation in terms of a learning curve for advisors that you feel would be necessary in order to interact with the AI, particularly when we're in stages where the AI might not be as sharp as we hope for it to be, might not necessarily be as accurate? What do you guys think about the advisor training piece?
I mean, I'll go first. I mean, I guess I see the question. I don't know that I fully understand it. But I mean, in my experience, advisors, there's a wide spectrum of advisors. Okay. Most of them don't want to know the nitty gritty of how these things work, right? In my experience, most of them want to have a tool that they can use with a client that maybe they've done some due diligence on. It gives them an answer, right? And so to me, when I read a question about risk tolerance and AI, like I think there's a ton that you could do. There are tons of, it's not gamification. That is the wrong word, Vince. I hear you, but doing things to make it a more immersive experience that's more realistic. So, I mean, I see like AI-ish type roles really helping, having unique experiences to help refine investors' risk tolerance in the future. I see that as a good thing for advisors, because advisors aren't going to be creating the tools. So if anything, I don't know if this was the question itself, but I see these tools as enabling advisors to have a better way to assess a client's risk preference than a lot of the incredibly rudimentary, basic ways they do so.
Yeah, absolutely. And I think as well as, oh, sorry, go ahead, Vince.
No, the one thing that I would add on that is, I think that in terms of who's responsible for that, there's a difference between the firm and the associated person. In other words, if the firm is providing a tool to the AP, and the AP, let's say that person is acting in good faith, but the tool is giving bad advice, that's the firm's issue. Whether or not it has a conflict built into it, which is the SEC's worry, or whether it just has some of these limitations that we're talking about, like the firm needs to explain to the associated person, it's good for this, it's not so good for that, or it has a tendency to do this and that, and you need to be on guard for that. And especially, I would think, if you're talking about younger associated persons, like, this thing is not a panacea. You know, it just helps to get you started, but you still have to learn your fundamentals.
Absolutely. I think that there's this risk of over-reliance on technology. And when the slicker it is, the easier it is, the more likely we are to rely on it. So understanding the blind spots of the technology, that helps us understand our blind spots as human advisors, I think is an important part of that ethical duty in terms of the work that people are doing. So how quickly an hour flies. There's so many questions that we didn't get a chance to address. So clearly we're at the beginning of a paradigm shift within the financial advisory relationship that will hopefully bring more financial advice to more people through technology, but doing so safely, I think, is of utmost importance. Vince, Christian, David, thank you so much for joining me today. I'd love to have you back to continue the conversation. There's so much that we didn't cover. Thank you to the American College and the administrative staff and support for helping us put on a fantastic webcast. And thank you to the audience for joining us today. We look forward to continuing the conversation in different forums in the future. Have a great day.